Hi, everyone. Thank you so much for joining on what has been a very turbulent week. I mean, we have gone from one extreme to the other. I'm going to dive straight in. We know what's happened. We have got a reprieve from tariffs for everyone apart from China for the next 90 days. That's quite a long time, and the markets have certainly reacted to it. Let's jump straight in, and we're going to take a look at the Bloomberg charts. Great, here we go. So what you'll notice, if you look where my arrow is, we are just hovering all around a sea of green today. Where my arrow is just shows you the moves in European markets so far. They're live. Obviously, US markets aren't open at the moment. They will be open a bit later. But we've got 4.5% move higher in the FTSE, nearly 6% move higher in the Euro stocks. Now, they have moderated slightly. They were a bit higher at the open, but they've still managed to maintain those gains. And I think that really is the key thing. US stocks, though, look at this again. Follow where the arrow is, please. You can see nearly 10% gain there, 9.5% gain for the S&P 500, 12% gain for the Nasdaq. And then if you just follow it further over to the last couple of columns on the right hand side of this chart, as you can see, we've moved away from that bear market territory. So this was a real move, significant move in markets yesterday. Just to put that into some context, we had Nvidia, that was up 18%. Tesla, it was up 22%. Apple up 15%. Now, what is interesting is that US equity market futures, so these are futures that trade before the market is open. If I just go onto a daily chart there, we should be able to see how they are performing, but they are in the red right now. So it's looking for a 94-point drop, so about 1.5% in the S&P 500 at the open, and they are pretty close to the lows now. So it seems like maybe that push higher, that near 10% rally in the S&P 500 yesterday was just a little bit too much, because we still have this air of uncertainty hanging over markets. And I think the bigger risk now is, how is this going to impact on earnings season? We'll talk about that in a moment, but just to put some of these moves in context, we have Nvidia is currently down 3% in the pre-market. Tesla also down 3% in the pre-market, and Apple down 2% in the pre-market. Some people were asking me about Apple, so I will show you this. Again, it's that mantra, isn't it? This is the Apple yearly chart. So these are each candle represents a daily price movement. So we saw that massive candle yesterday. If you go to the right-hand side of this chart where the arrow is pointing, that is a huge uptrend. So probably the biggest, well, definitely the biggest daily move for a very long time after gapping lower. Now, we haven't quite filled that gap yet, and we still are below the 200-day moving average. So yes, we've made a comeback, but we have not reversed all of the losses that we encountered last week. So that's just something to point out. Remember, Apple still impacted by tariffs on China. They are still real punitive tariffs on China. But I do want to show you the bond market. Just bear with me there. Oh, great, that's come up hopefully for you all. I want to show you the bond market because a lot of people say that President Trump paused on tariffs because of what was going on with the bond market yesterday. Bonds were rising really, really sharply in the US, also followed in the UK as well. In fact, they were higher in the UK. That really caused a lot of concerns that the sell-off in the market sparked by tariff fears would break something, because when it infiltrates the bond market, that's a real concern. But as you can see, a big turnaround today, particularly in the UK, not so much so in the US. This is the 10-year yield is down 2 basis points in the US, but down 13 in the UK. So UK bonds there, remember, yields move inversely to prices. UK bonds outperforming most others. And I'm going to take a quick look at that 30-year as well. As you can see, 30-year barely moved on the US, but down 16 basis points in the UK. And then 2 years, a bit of a different story. The reason why is that a lot of those expectations of emergency interest rate cuts from central banks, they're being priced out now. So that hence shorter-term yields are rising, particularly in Europe, particularly in Germany as well, because we had some safe haven flows into German debt. They're now being reversed as risk sentiment is slowly coming back into the market. So a volatile day, but volatile on the upside, I would say. Just going back to the stock market. Yes, okay, so we've got just kind of bouncing around these 6% levels in the Euro stocks. Let's take a quick look. What are we doing here? Yeah, these are futures. Again, they are just picking up the from the lows. Now, I just want to show you who the movers are. This is in Europe. As you can see, the European stocks 50, European Euro Stocks 50 index. Only one stock is in the red there, only down slightly, but it's being led higher by the like of Hermes, ASML, LVMH. We've got L'Oreal in there, we've got SAP. So you've got a real broad-based rally in stock markets, which is a sign actually that sentiment is fairly strong, even if they're not quite recovering all their losses from the last week. But really look at the two sectors that are doing very well. We've got luxury and we've got tech, and we expect tech as well. That's following on. Europe is following on from what the US did last night. So that means that what the US does when at the open, if it dips, if it drops dramatically, then we could potentially see Europe follow suit. But I would like to point out that over the last 5 days, we've had such huge moves. The distribution of moves has been absolutely massive. So standard deviations are kind of out the window. So actually a 1.8% move after a 9% rally yesterday is fairly small, although historically a 1.8% move to the downside is a very bad move. I also want to show you what's moving in the FTSE 100. Again, 97% of indices of stocks in the FTSE 100, they are higher today. Again, led higher by the likes of Games Workshop that had fallen very, very heavily because obviously it relies a lot on kind of cross-border trade, things like that. Pharma also doing well, even though pharma is expected to come up. There's expected to be tariffs against pharma, but we're just seeing a reversal in those moves. And that's why the likes of Games Workshop and AstraZeneca are moving higher, even though there is still the threat of tariffs. That's worth noting. But I want to take you to the other side, to the right-hand side here, where the arrow is. Tesco's down, Sainsbury's down, M&S down. Couple of reasons for that. Firstly, because they were defensive stocks that did well and that outperformed during the sell-off of the last week. So it's natural that when the markets reverse, so do the winners and losers. But Tesco is coming under pressure. Now, it is the weakest stock in the FTSE 100 today, and it's down over 5%. And that's because it released a profit warning. So it said that it lowered its profit expectations for this year, and it said it was down to weaker consumer demand, higher costs, certainly in line with national insurance increases, employer costs, etc. So not great news for Tesco there, but it does tell us a few things, because as I mentioned, the market is potentially moving not away from tariffs. They're still going to linger and we're still going to be looking at them, but looking at what other themes are going to dominate markets. And we are coming up to, we're in it actually, Q1 earnings season. Tomorrow we get US banks. Today, however, we did get that update from Tesco, and we'll be hearing from other British consumer-based companies as well in the coming weeks. So what it suggests to us, this sharp sell-off in Tesco, is that any company that doesn't meet earnings expectations or disappoints earnings expectations, they will get punished by the market, and that's definitely something to watch now. Now, what else do I want to show you? I want to show you the dollar, so the FX market. It's just a broad overview of how the dollar is performing. The dollar, as you can see, getting sold off. So those green bars show the Swiss franc, the yen, and everything else rising against the dollar. So the Swiss franc and the Japanese yen both up by more than 1%. Swiss franc actually up nearly 2%. Again, the euro also up by 1%. And we'll look at the chart for the euro in a moment. Pound is just about 0.77% higher. Pound strength possibly getting eroded by that decline in bond yields. But the dollar is weak today. So dollar is very, very weak. And that tells us a couple of things, especially because bonds aren't rallying either. So bond yields are still fairly strong, but yet the dollar is weak. It does suggest that maybe there is still that flight away from US assets and moving, could that, capital does move faster than trade. So if we see kind of the dollar continuing to weaken over the next potentially this is a sign it could continue to weaken over the next 90 days. Not a given, of course, nothing is. We don't know if that would happen, but it's just something to point out. We think treasuries will still be in demand. We had a very strong auction for treasuries yesterday, but there is a sign that investors aren't, aside from equities, aren't necessarily jumping into US assets. Now, they totally jumped into US stocks yesterday. It would be natural for us to see a pullback. So I don't think that necessarily means that stocks are going to fall off a cliff again. I feel like we have had the Trump put, Trump blinked, and that has now put a bottom in the market, which allows it to move higher from there. But just looking a bit closer at the euro, sliced right back above 110. And gone to our highest level pretty much since October. Remember, the high to watch out for there is 112. That is a really key resistance level in euro dollar. Let's look at dollar yen as well. Again, very similar. Dollar's weakening, yen strengthening. We're heading towards that 145 level, which then could open the way to 140, which is the low from September. So a very weak dollar. Some people could argue that's exactly what Donald Trump wanted, but he certainly got there and made a real mess of it while he was weakening the dollar, if that was the case. business. Now, I want to show you commodities. I know I'm bouncing about here, but I do want to get everything in because I know that you guys are probably really interested in what's going on. Look at my arrow. So we've got declines in the oil market today. Now, why is that? Some people had expected oil to really rally hard because of the turnaround in risk sentiment. We think that oil is falling today because, remember, there is still a massive trade war going on between the US and China. That we're seeing tariff levels that we've never seen before between the two countries. So that's really weighing on the oil price because they are the world's biggest economies. So even though the dropping of reciprocal tariffs has reduced the risk of recession, that's why equities in particular are rallying, because equities absolutely recession's kryptonite for equities. There still is concern about US growth, about Chinese growth, and they're both really vital for the global economy and for the global commodity market. So that's why we're seeing Brent crude really struggle to get back above $65 per barrel. It had done that earlier, but that could be good news for inflation around the world as well. And I would also like to draw your attention to gold. Now, what was really interesting was on Tuesday and Wednesday, we didn't see the gold price rally at the start, certainly yesterday. And on Tuesday, the gold price fell. That was a sign that liquidity was really draining from the market and that we were in a real state of stress in financial markets. And when that happens, that was a big warning sign. So now that there is liquidity back in financial markets, people are willing to buy again, buy stocks. That's why gold is rallying as well. I think that it's not necessarily rallying as a sign of risk aversion. There could be a bit of that, but to me, it's just more liquidity in the market, and that's what this shows. So as long as the gold price is moving higher, potentially we could see further gains in equities, but it will be interesting to see how things go today. Now, we talked about earnings being another focus of the market. There's another factor that could drive markets. Just to remind you guys, at 1:30 today, London time, we have US CPI, as if we don't have enough to worry about. But yes, we've got US CPI. Headline CPI is expected to tick lower, 2.5% for March, down from 2.8% in February, with the core rate falling to just a notch to 3% from 3.1%. But do watch out for this March report, because that will contain the impact of tariffs on steel and aluminium, and also tariffs on China. If we see any upside surprise in inflation, that could really draw down the market, drain market sentiment as well. So that could also turn sentiment towards US equities. So we do have that little hurdle to get past before US markets open. So that will be just about 50 minutes, just under 50 minutes time. So do watch out for that. That's going to be really interesting. But thank you guys so much for joining. Thanks for joining this overview in what has been a really interesting week, historic week for financial markets. So good luck trading today. Thank you.